Good evening. Doc Severson here with the Theo Night Report for Wednesday, December 20th. We got about 10 minutes left in the cash session right now, and with it looks like we're going to have the second red candle in a row after yesterday's massive bearish engulfing pattern. I say that in just because it was a 9-point move to the downside, which is hardly massive. So we're just seeing once again the market react to this daily exhaustion. So the last time we got into daily exhaustion down here at the end of November, early December, what we saw was 3 down days in a row here, 3 days to the downside at exhaustion. And that combines with monthly and weekly exhaustion. These are levels that we have never seen before. So what markets are doing is they're running as far as they can on fumes, and then they're consolidating until they build up energy again, and then they're running as far as they can on fumes. We may hit the 2,700 level by the end of the year. We may hit 25,000 in the Dow by the end of the year. One of the things that's happened over the course of the last week is the whole idea of the tax bill being first in, first out, which I talked about last week. So what they were going to do is if you bought Apple shares at 30, or if you bought Google shares when they were still $100 a share back in 2004, if you sold those, they were going to be used as the cost basis, was those original shares. And they decided to back away from that. So now it's going to be the same as it always was. So the issue here is, why bother selling this year? So if FIFO was going to be the deal, and there was a couple of times along here where FIFO was starting to be hinted at pretty strongly, and I think this is what led to some selling here in mid-December. But right now, FIFO is off the table. So I think today is more than anything else kind of a sell the news event at the end of the year as markets once again hit exhaustion. So that's the S&P going nowhere. Here is the Dow. The Dow is even stronger to the upside in terms of this exhaustion. It's hit exhaustion a couple of days ago. So here we go, 2 days in a row to the downside as well too, but actually just, these are what I call railroad tracks, because it's just basically walking sideways. You can almost draw the rails on here with these candles, just doing nothing whatsoever. And lastly, here's the Nasdaq, and the Nasdaq is also in monthly and weekly exhaustion. Does have a little bit of energy left to push to the upside, see if it can hit 6,600. Again, we'll talk about these in just a second here, but probably with looking at next week, we're going to see one of these, again, drifting days or weeks to the upside. We've got a 4-day week next week, right? And most of these weeks have a general positive bias, especially this week with, there's no real rush to cash in for end of year tax loss selling when the tax rates are actually going to be lower next year. Now, the last thing in the world that I want to do is position myself as a tax expert. My brain usually shuts off when I start hearing the word tax, but this is what I'm hearing, is that there's going to be a little bit of a difference in terms of how companies are going to be treated in terms of this new corporate tax rate. So some companies are taxed more than others. So industrials and financials and consumer products, right? Consumer products are going to be taxed generally a little bit higher. So they're going to be closer to that 34% rate. Whereas most technology companies are normally taxed at around the low 20s, so maybe 24% rate. So you start to do the math here, and there might be a shift here actually out of technology, because they're going to have a lot less benefit from the new tax package than are companies with the higher tax rates, such as consumers, financials, industrials, sectors like those. We may see a little bit of a shift, and notice how these are the big ones here. These are the highest weighted. And so we might see some money flow out of these as we get into the new year and back into these. So nobody's going to be moving anything just yet, but you may start to see this creep over the course of the next week or two. And then maybe as we get into January, we are going to see more of this rotation. Now, this rotation actually could get to be violent, and we're already starting to see that in the charts. So here's a chart of the S&P 500, and it's got the ATR or the average true range down here at the bottom study. And you can see that over the course of time, I brought this up several times in the last few weeks because I'm starting to see this pick up down here. Notice how low this was in October. So you can start to see as I zoom in on this, we're starting to see this sort of stealth move higher in volatility. So the average range of a daily candle is starting to get bigger and bigger and bigger. So we come along here as we get into the end of the year. And what this means is kind of like a fireman trying to chase a live fire hose, is that we're going to start to see more instability coming into the market, I believe, as we get closer and closer to January. And then as we transition into the new year, I think we're going to see more of that volatility come into the market. So even though it's not necessarily going to cause the market to crash, I do think that this is sort of a very quiet tell that the market is trying to tell us something, that volatility will be making an appearance, at least to a modest degree, as we get into the new year. Now back to the S&P chart, if we go back here to the end of 2013. So 2013 was the last time that we had a market that was just on a one-way tear. And actually, what we've seen in 2017 has been a much stronger market. Now, we haven't had necessarily the same vertical amount of movement that we have just in this year alone as we did in 2013, because that move started right at January 1st of 2013 and did not let up. But as we transitioned into 2014, what I want to call your attention to is here we had a very quiet market as we made it into the very end of 2013, and then it started to get unstable and come unglued. Actually, this did drop for about 6%, which would just be about right. So I'm looking for about that type of move as we get into January. Somewhere between 5, 6, 7%, I think, would generate a tremendous amount of negativity in this market, because we haven't seen anything like this really since Brexit. We have not seen any significant red candles other than occasional missile being fired through this year. So I think this would cause a relatively large slingshot move as we get into January, as we get into that rotation, and then we'll probably see the market pick up the baton for right now, at least into the first quarter or so. All right, quick update on Bitcoin futures. So Bitcoin futures made their debut about 10 days ago with the SIBO, the XBT futures. How about this? We've actually seen a little bit of downside this week. Now, the one big change is that we now have the CME adding their own. So this is the /BTC contract. Now you're going to see off of a tick chart, these are 133 ticks. We've actually had lower volume on the CME contract because it's a big one, and it's just not very retail friendly for this contract. So you can see if we just go to the BTC here, just today we've only had 754 contracts on the BTC, whereas on the XBT we have had 4,200 contracts. So now they're actually allowing retail traders to enter short on these contracts. It's making a difference. But as of yet, we're really not seeing a whole lot of institutional volume because it's nearly impossible to arbitrage or manage risk across these contracts, just because of the fact that Bitcoin takes so long to execute a transaction on the current blockchain. So there we go. We're getting a dip in Bitcoin, which people were praying for just a week ago. And now everybody is saying, I don't think I'm going to step in front of this one just yet. That's probably a wise attitude. All right, folks, that is it for today's report. Thanks for listening. We'll see you tomorrow.